Hi, good morning. Welcome. I want to thank each and every one of you for attending this virtual webinar. My name is Noreen Hogan. I am the president of both CMB Regional Centers and also the president of NHK Capital Partners. In just a few minutes, you're going to be hearing from Mr. Neil Lee. Neil is our Vice President of Finance. He'll be talking to you in more detail about the current investment opportunity in the JW Marriott in Dallas that we have. However, prior to him starting, I wanted to just take a couple minutes and provide you some background on the NHK company and how it began. And some of you might have even stumbled upon our story based on our website. But the simplest and the most straightforward reason that NHK was formed was truly because of the success of one of our affiliated companies, CMB Regional Centers, and the success our clients and us as a company have experienced. Many of you, on this webinar actually are current investors in one of our different EB5 partnerships. Some of you are considering EB5 or have considered EB5, and then others are brand new, and we look forward to those relationships. And for those who aren't familiar with CMB and EB5, I just want to take a quick moment to digress from our NHK webinar and just give a very quick background, because this is truly the foundation of why we're here today. So the EB5 visa program is actually a vehicle for foreign nationals and their qualified family members to be able to obtain a permanent green card in the United States. The EB5 program requires that each investor invest either $900,000 if the project is located in a targeted employment area, or invest $1.8 million if a project is located outside of that targeted employment area. And then in order to meet the requirements of the EB5 program, the investment that the investor ends up investing into needs to create 10 new American jobs. It has to be fully at risk. And that's really where CMB comes in. And CMB is a regional center. And what we do is we provide EB5 investment opportunities that are going to meet the needs of the EB5 clients in pursuing their green card through the EB5 visa program. CMB is one of the oldest active regional centers in the industry today. We've had nearly 6,000 investors and their families decide to move forward with CMB in pursuing their green card. We have a track record of 100% success when it comes to our adjudications of our projects from the USCIS, the governing body that oversees the EB5 program. And really, the most important thing is that CMB's philosophy has always been that take care of our clients. And if our clients are successful, we as a company will be successful. And as I rambled off, that one of the oldest active, our track record, all of that was truly built on that foundation of taking care of our clients. And so that philosophy has essentially translated into our clients, our EB5 clients coming back to us and saying, hey, Noreen, hey, Pat, Neil, you guys have made good on what you said you were going to do, green card, and I now have my money back, my investment back. Do you have any more traditional investment vehicles that you could offer where I could earn a more market return? Because we all know that the return on an EB5 is truly the green card. And we actually had several limited partners come to us and ask us that, and we realized this is a true opportunity to be able to provide our investors something that we're already looking at, which are non-EB5 investments. And so thus NHK truly was born from our EB5 clients achieving success through their investment with CMB. So we're really humbled by truly the success of our clients and them asking us to essentially continue a new journey with them in a new investment platform. CMB and NHK were uniquely suited to be able to evaluate new investment opportunities just based on the nature of what we've been doing in EB5 for so long. We've been around for 20 plus years. We have a deal flow come in through our current borrowers and new borrowers, and developers come to us, every day to see if we have the capacity, and they don't always qualify. These investments don't always qualify for EB5. And, the Hogan family, we've been very lucky because with the success of our EB5 clients and CMB, we've been successful as a family. And prior to even NHK being formed, we've looked at various investment opportunities and made family investments. And what we see for NHK is it's essentially combining, in a way, a lot of the competencies that we have and we currently do with CMB and also with our family investments. And so we see NHK for our family as a way to allow others to participate in investments that we otherwise would be doing. But with the participation of others, it allows us to, further diversify as a family and put money into, 10 projects as opposed to 3 projects. And so one thing you can rest assured is that if we put a project, when it comes to NHK or CMB, out in the market, it comes to CMB and my grandma was not a U.S. Citizen or a green card holder, we wouldn't put a project out that, we wouldn't put our grandma in. When it comes to NHK, it's the same philosophy. I'm not going to put a project out in the market that I won't put my own family money into. And so we participate in these NHK offerings. We participated in our first NHK, and we're also participating in this. And like I said, that's exactly what we plan to do for the future. Is we're essentially allowing others to invest alongside the Hogan family. And there's one other synergy that I wanted to touch upon before I hand the microphone over to Neil between CMB and NHK. NHK could actually serve as a more temporary investment vehicle for those wanting to pursue EB5, but for currency restrictions, for capital markets issues, and maybe not being able to sell an asset right away to have the full $900,000 to invest. NHK actually could be an opportunity that our investors might say, EB5 is going to be right for me, I think, in 3 years or 2 years or a year, whatever that time frame may be, and they can actually invest money into the NHK platform. And if someone wants to move forward with a CMB investment, we would look to be able to take out their capital and transfer it at their discretion to a CMB EB5 partnership. And so it's been really interesting and really fun. And, we really enjoy being able to see a synergy between where we've had long-term success in CMB. We're able to bring investment opportunities that the family is going to be able to participate in and open it up to a wider audience. And so we really look forward to the opportunity, if you're a current CMB investor, to continue to work with you and continue to be partners. And then if you're new to CMB and to NHK, we welcome you and we hope you become, part of our family. So thank you very much for your time. I will turn it over to Mr. Neil Lee. Thank you very much.
Again, thank you for joining us today. It's an honor to be speaking with you. My name is Neil Lee. I serve as the Vice President of Finance and Chief Finance Analyst for CMB as well as NHK. I've been with the CMB Regional Centers for the last 7+ years. My background is from a commercial real estate investment / development background with a large EPC and real estate investment firm. And so with that, I think I have a few announcements just to begin the process. If you look at the bottom of your screen, you'll see a Q&A button. And so we are going to be receiving live questions through that Q&A function. And at the end of my presentation, I'm going to invite Mr. Matthew Temple, my senior associate, and we're going to go through some frequently asked questions. Matthew has been talking to a lot of prospective NHK investors over the last few weeks. And so he will provide us with some insight on what are the more commonly asked questions, and we'll address them, as well as look at the questions that are uploaded during my presentation, and then we'll try to address as many of them. As many of you probably already know, here at CMB and NHK, we use and we're able to communicate in many, many languages, Mandarin, Vietnamese, Russian, Spanish, Portuguese, Farsi, Korean, Japanese, you name it. For the sake of this Q&A, I would ask that you upload the questions in English so that we can react to in real time through this presentation. With that, before probably I go into the actual main presentation, a couple things that I would like to mention that might be helpful in kind of forming your mindsets and in understanding what the JW Marriott investment opportunity looks like. The first of which is, again, since we have a large pool of investors who have experienced CMB and our limited partnership structure, this might not come as too much of a learning curve, but the NHK partnerships are similarly structured as a limited partnership. And what that means is you, the investor, would participate in this investment as a limited partner with limited liabilities. And NHK would then join as a general partner, and it would have the responsibility to operate the partnership, the investment on a day-to-day basis, so that you, the investor, the limited partner, can truly enjoy a passive investment platform into complex commercial real estate opportunities here in the US. And I know that for many of us, especially if you are calling in from overseas today, that one of the main limiting factors in having exposure in commercial real estate is probably the complexities and the burden of having to manage that investment on a day-to-day basis. And that's why a limited partnership structure might be right if you're looking for a more passive approach to your investment. The other question, just to address it up front, is probably the 800-pound gorilla in the room. And without going into the details of what our investment looks like, you might hear people talking about why invest in a hotel now, during this COVID world. And I think there are a few things that we can think about that, again, will set our mind, frame of mind in the right direction. As we know, we've been going through this COVID world the last 10 months now, and it's not fun. And we at CMB, we also are seeing some distress, especially in the hospitality market, and that is probably understood because we don't travel as much. The travel has steeply declined. We work from home. We do Zoom meetings instead of actually traveling and meeting people. And so that all takes a toll on the hospitality market. However, I think by the token of our you joining this call today, you and I probably have a fundamental optimism about the economy, the US economy, actually, the global economy in large. And once, we have some form of relief, either it be a vaccine. I think everyone should appreciate and understand that there is a pent-up demand, that people want to travel again and people want to do business as usual. Now, during this duress, during this COVID affected period, as I mentioned, the hospitality industry have seen a great deal of distress. And for those marginal hotels, we are seeing them either closing their doors or looking at different means of sustaining themselves. And so this is probably true for, in a historical sense as well, that um, in these downturns, in these recessions, or I shouldn't even call it a recession, in these downturns, the marginal hotels that probably are old, are dated, that need some additional renovation would probably be the first ones to go. What that means is whoever is able to survive and weather the storm and be the so to speak last man standing at the end of this is probably standing to reap the benefit of a larger market share. And that's exactly the play that I think we're eyeing for when we talk about this JW Marriott hotel. Now, maybe go on to see what the experts say about the next few years in the hospitality industry. This is a chart that shows some forecasts about the U.S. hospitality industry. It's coming from CBRE and Smith Travel Research, probably the largest hotel advisory consultancy firms in the world. And if you look at, I've marked them in red circles, as you can see. 2020 is a dead year, and I think we all understand that. We've seen a steep decline in the hotel market. So just to give you maybe some context, ADR means average daily rate. What that means is it's the daily rate, the room rates that the hotels in average, and this is US average, would charge, and RevPAR, or revenue per available room, takes into account the ADR and also the occupancy level. So as an easy way of understanding, if I'm charging $100 for my room, but I'm at 80% occupancy, then my RevPAR, or revenue per available room, is $80. 100 times 80% equals $80. So what it's saying is, in 2019, the US average RevPAR was at $86. Now, it halved in 2020, as understandably so. It will take another about 2 years to recover. However, by 2022, by 2023, we will have recovered to the pre-COVID levels of RevPAR. And as we will see, JW Marriott Hotel is just breaking ground. Actually, Noreen and I are invited to the groundbreaking ceremony this afternoon. And so it's going to have a 24-month construction schedule. So it pretty fits well with this, outlook. Now, maybe go back a little more in time and see what the history tells us, what the last down cycle recession showed. And as you can see in yellow, this was our 2008 financial crisis. As we all know, there's been a similar steep decline in demand because of the economy around the world, crashing in a simultaneous fashion. So we see this crash over that 2008, 2009 time period. However, you see a pretty significant recovery, from the bottom point all the way until 2017 and 2019. As you saw, the 2019 average RevPAR was at $85. So, this trend continues to 2019. And if you look at how long it took for this downturn to have recovered to the previous levels, wow, you're at about 2-3 years of recovery, which is probably pretty consistent with the previous chart that we saw, where the experts are expecting the previous RevPAR levels to resume by 2023. So again, this is probably the mindset and the strategy that this JW Marriott Dallas, Texas offering is premised upon. And so now I'll go into the main presentation and explain to you what this is about. So the JW Marriott in Dallas, Texas, will consist of 275 keys or rooms, and it's there are already agreements with Marriott International to brand this as a JW Marriott. And it's located in the heart of the Dallas Central Business District. And, it's probably in the most central location that you could ever imagine in the Dallas downtown CBD area. It's located with large employment areas in Dallas in walking distance, as we will see in the coming pages. JW Marriott is also a key anchor to it's not just this hotel. It's the entire block is being redeveloped by JP Morgan Chase, and this hotel is going to be the cream of the crop, the cherry on top of that redevelopment, revamp of this city block. And Marriott is, so bullish about this project that they're also investing skin in the game, as we say here, $2.5 million in key money, and that will be used to further subsidize the operations for the first, few years of the hotel opening. Quickly on Dallas, Texas, and this is probably more for those of us who aren't as familiar with the U.S. Geography. But Dallas is the largest city in Texas. It is not the state capital. State capital is elsewhere. However, Dallas is the largest city in Texas. And Texas, in turn, is the second largest economy in the US. And if you were to look at Texas as a standalone country, would be the 10th largest in the world. I think they would be ahead of South Korea and a few others that are pretty big GDP heavyweights. So Texas's GDP is actually a hair below $1.9 trillion in 2019. Per capita GDP ranked at $65,000 per capita, which is pretty significant. The Dallas-Fort Worth, Arlington, or as we call it, the DFW, that's the metropolis that Dallas is part of, is the fourth largest in the US. After New York, after LA, after Chicago, it's Dallas. And the interesting thing, the fascinating thing actually about Dallas is that Dallas is probably the only metro area that has gained more new residents since for the last 7-8 years. And if we count and add up all the additional population that have moved to Dallas, it amounts to 1 million people. And by a growth average, it ranks at 2% growth per year, constantly. And just yesterday, I think it was, Elon Musk also announced that he's moved to Texas. He hasn't disclosed where. We all know that his gigafactory is in the San Antonio region, and SpaceX is in the near the Gulf area. So it'd be interesting where he actually moved in Texas. But I think this is representative of a trend. People moving from high cost of living areas such as the bi-coastal areas to Texas for many reasons. For the fact that we right now have a sunny 65-degree weather in December. The fact that Texas does not have a state tax, which is a large factor when you, especially for business people. And just zooming in a little bit about where the hotel is located. This orange star you see here is the location of the hotel, 2000 Ross Avenue. You can see that it's truly in the heart of the central business district, and around it, basically in walking distance, you have 160,000 people, in employment. And every year there's about 7,500 new employees that are being brought in to the CBD area as additional employees. That occupies another 2 million square feet of space, office-wise. And Dallas is home to about 6,500 businesses right now. 500 of them are Fortune 500 companies. And as we will see, the heavy hitters such as JP Morgan Chase, Goldman Sachs, and Texas Capital Bank, Merrill Lynch, they're all here. And so this is truly where the business happens. But also, this is where the entertainment happens, and the subset of where this hotel is located is called the Arts District. And just across the street, as we will see later on, you have the Dallas Arts Museum, and onto the left side of that, you have a historical old Presbyterian church that is beautiful to look at. And so there's so many things that are going on here. Zooming in a little more into the actual city block, and as I briefly mentioned before, this JW Marriott Hotel is not just a standalone one-off hotel. It's rather a part of a larger city block-wide redevelopment that is spearheaded by JP Morgan Chase. And just across the street, so this would be on the other side of the museum I just mentioned, we have what we call the Trammell Crow Center. It's a 1980s, a very landmark office building here in downtown Dallas. And JP Morgan Chase recently purchased and went through a $140 million renovation of that center. And with the completion of that renovation, Goldman Sachs decided to consolidate their regional operations to that building. And so the renovation, which was concluded last year in 2019, the occupancy level is already at 90% plus. And so now, naturally, you've brought in all these high-level employees, people, Fortune 500 companies. Now you want to entertain them. You want to have a place for them to go. You want to have a hotel that is commensurate to the level of that high echelon, high paid employees in order to function, to have events, business meetings, and so forth. And that's where JW Marriott comes in. There is a video introducing the Trammell Crow Center. It's about a 15-minute video, so I won't play it here. But if you have interest in viewing that, we can definitely provide that. So, please either leave it in the Q&A section, or I will leave an email address at the end of this, and you can email us directly, and we'll be more than happy to share that with you. A few words about the actual hotel. So as I mentioned, it's a 275 key hotel, and the unit mix is mainly king and double rooms, as understandable. and 36 suites. Also, a high level finish amenities, fitness center. There's an outdoor pool at the 11th floor. So as we will see some renderings of it. It's a beautiful area. It's a rooftop area. It's outdoors, and there's going to be bars, and the conference spaces are going to be organically linked to that space, so that from the conference you can come out, get a drink at the pool bar, and then go back to your meetings and so forth. So as you can see, the focus here is mainly for that business travel group, as well as transient group that are visiting Dallas for as a tourist, because as I mentioned, this is where you want to be if you're visiting Dallas as a tourist, and this is where you want to be if you're visiting Dallas is for business, because you're now in walking distance to probably where you need to go. So for that, there is ample meeting space as well. There's a grand ballroom, junior ballroom, 6 meeting rooms. Again, they're all organically connected to that pool, the outdoor area. So it provides a beautiful view of the downtown area, as well as have a sense of space. Some renderings here, and a few things to mention here. This red stick that you see at the bottom left of the screen, that is part of the Arts Museum, as I mentioned. And across the street from it, you see part of that old church that I mentioned. And another thing that's worth mentioning is this JW Marriott Hotel is going to be built on top of an existing parking structure. And so the bottom podium part of this rendering is actually already built. And it looks exactly like this rendering. The outside is a stainless steel facade that just begs attention. And this JW Marriott Hotel is going to get built on top of this 10-story building, another 15-story of a hotel, so therefore the top floors of this JW Marriott Hotel will be at 25 floors. And the aforementioned outside area, the pool area, is going to be here, along with the conference space on top of the existing podium rooftop. Before I go into probably some numbers I just wanted to maybe reiterate some of the key strengths of the JW Marriott Dallas property. One, it will be managed and operated by Marriott International. Marriott International is the parent company, the Marriott that we all know of. And Marriott is also investing $2.5 million in what we call key money. And this will be used in further operations during the period where the hotel opens, and go through what we call a stabilization period. And this project is part of the landmark Trammell Crow Center master plan development. So it's not just this one-off hotel that just exists without any, organic connection with the surrounding. Rather, it's a key piece. It's of a city block-wide redevelopment that is tied with a successful renovation of an existing landmark office building. Goldman Sachs is already a tenant at the Trammell Crow Center. It's along with Goldman Sachs, the entire office building is 90% plus occupied. Hasn't changed over the course of COVID. And another interesting factor about why this JW Marriott is sounds like a good idea is because the other large flags, for example, Hilton, for example, Mandarin Oriental actually tried to come in, and they actually are the news is that they are not pursuing anymore. But there is a large barrier to entry because these hotels, for example, Hilton, um, because of the existing hotel in the area, there is a non-compete that bars from any other Hilton affiliated brands to come into the market. And so what that means is JW Marriott, and it will see in the competition analysis, is truly going to have a moat and a competitive advantage over other flags in this downtown area. SMG Group, they're the developer and also the sponsor of this project, is a deeply rooted family-owned company here in Dallas, Texas, very well renowned. And they already own and operate 3 other hotels, as well as other retail and other commercial real estate properties across Texas. And so that is another strong factor that I wanted to emphasize. Without maybe much further ado, a quick look at the competition, the comp set as we call it. So this is a list of properties that are deemed as as competition, and this is part of a third-party report done by HVS. HVS is another worldwide hotel consultancy firm. And what they saw was that in this immediate vicinity, there are 1, 2, 3, 4, 5, 6 different hotels at that 5+ star level. However, except for the 2 that I've highlighted here in yellow, all the other hotels are independently owned and operated. What that means is, not necessarily does independently owned mean that it's a bad thing. However, for those travelers who want a consistent experience, in paying large dollars to stay at a hotel, not to mention the 120 million members of Bonvoy, which is the Marriott membership program. These they would probably look at either a large flag rather than risk and of having a subpar experience with a independent owned franchise. So looking at the larger flags in the market, there's truly only W Hotel. W is a Sheraton brand, and W is design oriented. So meaning that they have a very unique design factor to their hotels. Some like it, some don't. But it's probably a little bit of a different client group, if you will. And obviously, Ritz-Carlton is located in Uptown area in Dallas. Uptown is a few kilometers away from the downtown area, so not necessarily walking distance to the downtown, center of employments. But Ritz-Carlton, regardless, is doing very well. As you can see, the W and the Ritz-Carlton, I'm going to focus on the 2 because they're more of our competition, if you will. For example, Ritz-Carlton is consistently operating at an 80%, 85% occupancy. Average room rates are anywhere, between $375 to $400. So as I mentioned, a RevPAR wise, that comes out to about $300 to $325. Now, compared to that, our key assumptions are that we will start with a 69% occupancy and average room rate of $300, which would yield to a $210 RevPAR. And I think our next page would show what the significance of that number is. So when we underwrote and this project, obviously we are looking at the operations side of this hotel in order to understand how our return is going to look like, and how our ultimate exit is also going to look like. And therefore, this pro forma, this projection was actually done by Marriott International themselves. So Marriott has been in the hotel business for the last 150 plus years, as we know. They tend to use conservative projections, and under their projections, this is the yellow highlighted section is the RevPAR section. As I mentioned, it starts at 210 RevPAR on the first year of operation, and it goes up as the occupancy goes up. And long story short, at about 200, they're expecting about a $250 RevPAR, and under that RevPAR, the net operating income, which is where our return is going to be, or is going to originate from, they're looking at an annual net operating income of 10 million that would increase to 13-14 million dollars. And then there would be an exit, a liquidity event, a refinance, or a sale of the hotel, likely a refinance that will take out our main investment principal, and that would be the event that will return the investment back to our limited partners. A quick look at what the project sources and uses look like. So this is a $132 million venture. As I'm going to talk about a little more in detail, NHK is out raising $10 million out of that $132 million tranche. The $80 million senior loan is already in place. It's by a local bank by the name of Bancorp South. The mezzanine loan of $27 million is also in place, and that is done by an affiliate of NHK. And the sponsor equity of $10 million is obviously $11 million is also in place. So truly, the only piece that is missing in this $132 million venture is that NHK piece, which we are actively subscribing investors to currently. The usage is as below, the $8.5 million in land. The bulk of it is obviously the construction cost, which comes out to about $105 million. Probably one silver lining through this COVID is that the labor and the materials costs have gone down. So the risk of a cost overrun is less likely because of COVID. And so the engineers, the owner's engineers, the general contractor all feel that this is a solid number that we'll be able to abide by. This all comes out to about $495,000 per key per room. So this is just dividing by that 275 hotel keys. Which I think it would represent a good cost basis for a 5+ star hotel in a major metropolitan area in the US. A few words about the actual investment offering structure. I think the first thing to mention here is that we structured this as a equity loan, and what that enables us to do is unlike a straight up equity investment, because it's a loan structure, we have the borrower as an obligated party to service that debt, meaning pay interest, and have an obligation to pay back the principal of our investment. In order to emphasize that, in order to create a better collateral position, the NHK was able to negotiate a guarantee from the principals. The principals, so Samuel Moon, Daniel Moon, and David Moon, these are the two sons and the father of the SMG Group principals, along with their trusts. are guaranteeing the principal amount, the $10 million, as well as a 13% interest through the life of this loan. And we also have a profit participation at the back end, at the end of the investment, when this hotel goes for a refinancing or a sale, as a bonus. And what that looks like is that it's going to enhance the return for our investors, as if we are an equity investor. So we're trying to simulate the I guess the upsides of both worlds, of being a debt, a loan with obligations by the borrower, but also trying to emulate a return profile that is more akin to an equity investment. At the partnership level, we expect this target investment to outstand for the next 5 to 6 years. The mentioned loan is for 7 years. However, there's an economic incentive for the borrower, for the sponsor party, for the developer to pay this loan back as early as possible. And by the agreement, by the loan agreement, there is a lockout period, and therefore the soonest that they can repay is at that 5-year mark. And so we are expecting the money to be returned at that 5 to 6 year mark from today. The target closing date, and this we're expecting to continue to raise this for a few more weeks, and you will see that there is a one-time subscription fee of 5%. So simply put, if you invest $100,000, $95,000 will go into the actual investment. $5,000 or 5% of your 100,000 will be a subscription fee payable to the general partner. There's an annual management fee of 2%. As I mentioned, this is structured as a loan, equity loans, and therefore it pays a 13% interest. This 2% annual management fee will come out of that 13%, meaning that the annual distribution to our limited partners, to our investors, will be anywhere between 10 to 11% annually, paid on a quarterly schedule. The projected returns, as I mentioned, the current distributions, meaning the annual distributions from here throughout that 5 to 6 year investment period, is going to be at around that 10–11% after the annual management fee is taken out. Through this 5 to 6 year investment period, we are targeting an equity multiple of 2.0x, meaning if your $100,000 investment, at the end of the investment period, we're targeting it to become $200,000, $100,000 of your principal plus $100,000 of profit. And if you calculate that into an IRR form, that amounts to about a little over 17% IRR. And if you calculate that as a annualized target return, then it shows as a 20% return for the next 5+ years. As I mentioned, the loan itself is for 7 years, and therefore, if for any given reason this investment outstands for another year, say to fulfill the entire 7, then the return obviously will go up because it's a function of time. This is a quick view of what that investment structure or return looks like. So without having to go through all the details, the main highlights are, and this is at a partnership-wide level, the $10 million here go in as a contribution or the investment, and every year you get about that 10 plus % of annual return, which comes out to about $1 million and change. And at the end of the investment cycle, you have what, as I mentioned, the capital proceeds distribution, or the bonus payment that is part of the profit participation, that would amount to another, $5+ million in order to make up for the targeted IRR return of 17%, 17.2 to be exact. And in form of equity multiple, this would mean that for the $10 million that we put in, that we would get, $20 million of return. And these are all targeted returns. It's a forward-looking statement, as we all understand. And before I probably finish my presentation, a quick word about the Sam Moon Group, our sponsor. As I briefly mentioned, Sam Moon Group started its operations here in Dallas in 1984. They started out in the trade as a trade business. They trade in women's jewelry and textiles and fashion items, and they since have diversified to being an owner and operator of large retail centers all across Texas. They have a large campus, multi-use campus that is being constructed right now near Woodlands in the suburbs of Houston. They also own a golf club, and 3 additional hotels are in operation. One is a Renaissance in Plano, which is a northern suburb of 30 minutes away from Dallas. Another Hyatt Place in Fort Worth, which is again within the metroplex of Dallas, DFW as we call it, and another Hyatt in Frisco, which is another booming neighborhood of Dallas. Of these hotels, we picked Renaissance Plano as maybe a case study, and the reason for that was because the team that designed and built this Renaissance hotel and operated this Renaissance hotel are exactly the same as the one that are involved here in JW Dallas, Marriott Dallas project. So HKS is the architect behind this gorgeous hotel. HKS is a preferred architect, by Marriott, and they have been designing this JW Marriott hotel, and Marriott International, the Marriott themselves, are the operators of this Renaissance hotel, as they will be in the new JW Dallas hotel. Now, this Renaissance hotel briefly was a 304-key hotel, a 15-story hotel, and I visited there in person. One of the fascinating thing was, we walked around with the rendering, so the architectural designs, to basically compare the actual versus the drawings, and it was amazing how in sync those two were. I would say it's 98% sync. And the owners as well as NHK, we all believe that this will be replicated in JW Marriott as well. This Renaissance hotel it's not just me that thought it was an awesome hotel. They were chosen as a #1 Renaissance brand in 2019, Hotel of the Year 2018. Again, overall satisfaction #1 in 2019, best venue by MPI Dallas in 2018. So I know I probably have gone a little over my allocated time. Now, again, our website is here at nhkcapitalpartners.com. The 2 email addresses, feel free to send your questions, or if you want to speak to a speaker of your language, whether it be Russian, whether it be French, Spanish, whatever. I think we can definitely accommodate that. And with that, I'm going to bring in my senior associate, Matthew Temple, as I promised to go over some FAQs, frequently asked questions, and maybe field some of the questions that we have seen come in over the course of my presentation. Matthew, you there?
Hey, Neil. Yeah, I'm here.
Hey.
I don't know if you guys can see me or hear me, but yeah, as Neil mentioned, I work with NHK too as kind of senior project associate. I help Neil with underwriting. I help him with ongoing monitoring, and one of my other main tasks is communicating with investors who have questions pertaining to this investment or project details. So going through the last I think 2 to 3 weeks, we've had very common questions that we just quickly wanted to cover. And I think I'd start with the first question if you're ready, Neil.
Yeah. So what was so why don't we do this? Why don't you ask me the FAQ, the questions that you have maybe solicited from your previous engagements, and then maybe we can address them.
Yeah, let's do that. Okay. So one of the most common questions that I've received is, investment options or the investment path. Can I invest normally as the individual? Can I invest as an LLC, a trust if I have one? And then what are the tax consequences?
Sure. So technically, all entities, U.S. or foreign, have the ability to invest. Now, this investment is for accredited investors. If you're a U.S. person, whether it's and that's the same across whether you're an individual or an entity. And if you're a foreign individual or entity, then you're exempt under what we call the Reg S, because the Securities and Exchange Commission here in the U.S. doesn't have jurisdiction over you because you're a foreign person. So again, we work with Prevail. And many of our listeners today might be familiar with Prevail, but they're a third-party broker-dealer, and they're regulated by the Securities and Exchange Commission. And we would get their approval to go through, look at the accreditation, as I mentioned, whether it be individual or an entity. And they would look at source of funds, but it's a very, very well-oiled process. We've been doing this for as Noreen mentioned in the very beginning, we have 6,000 close to 6,000 limited partners, investors on our CMB platform, and Prevail is engaged on our CMB platform as well.
Okay. I think also just to quickly add there, what are the tax consequences? I've also worked in the accounting background and have issued K1s through the CMB side of things. And if any individuals have invested with CMB, obviously when you invest into a partnership, you're issued a K1. Now, if you have a Social Security and you are a U.S. tax-paying citizen, that K1 distribution will be obviously fully paid out. Whereas if you are a non-U.S. tax-paying person, there will be, that withholding of approximately 37%. So just wanted to point that out really quick.
Sure.
Okay. Second question, how much can I invest? It's a very simple question asked over and over again.
Sure. So we structured each unit of investment to be at $50,000, and we have a minimum of 2 units, meaning $100,000 minimum of investment. And from there, it's truly at a $50,000 increment. So it can be $1 million, it can be $1,500,000, million and $500,000. I'm sorry. So whatever it is, it's in $50,000 increments from thereafter.
Okay, great. So I had this question actually in the chat earlier. Can I cash out and sell my interest share prior to the closing of the investment?
Um, a good question. So this is a closed loop investment, meaning that once you decide to invest, you are expected to stay within the investment for the entire duration. So that would be the 5 to 6 year target investment time frame. And the limited partnership agreement that you would sign if you were to invest with NHK clearly states that you are in for the entire ride, that you are in as a for the entire period. So I would advise that you make sure that you have your finances, you understand your finances, and that this is an illiquid investment, and that you are looking at staying in within that 5 to 6 year time frame once you do invest.
Okay, thanks. Question we just got in the chat, which is our fourth question we have pre-scripted, is what are the risks? What is the security and protection in place for my investment?
Sure. That's a pretty loaded question. Maybe we will have to dissect it a little bit and maybe answer it in a step-by-step fashion. So the risk is the one that we can all perceive. Meaning, we're talking about investing in a five-star hotel during COVID. And so there, you can imagine all sorts of risk profiles that could come with such a proposition. And as I mentioned, just previous to this question, that it's an illiquid investment, that once you do invest, then you are expected to stay in, during that entire target investment period. Now, however, the main existence of us, of NHK as a general partner, is to structure this deal, this investment, such that we mitigate the perceived risks, right? So how did we mitigate it? Well, a few things, right? So first off, as I mentioned in the presentation, this is structured as an equity loan, right? Meaning that there is a loan agreement, there's an obligation by the borrower to repay, and there's an obligation by the borrower to pay interest. And so number one. Number two, within the loan agreement, and we have what we call an interest reserve. So for the first 24 months, which is the construction period, the interest payment for our $10 million is already accounted for. It's already sitting in cash form in a controlled escrow account. So for the first 2 years during construction, we know that we're going to get our interest paid. And thirdly, and I think I also mentioned this in my presentation, Marriott International is investing $2.5 million of their own money, of key money, as we call it, and that key money is something that can be used to subsidize the operations. So typically, with these hotels, what happens is there's a 2-year construction period. And then once you open the doors, then you have to get the word out that you're open for business. You're doing promotions, you're doing marketing, plans. And so we call that a stabilization period. Here, we're looking at probably a 3-year stabilization period. It could be shorter, it could be a little longer, but that gets us to that 5-year term. And so during this stabilization period, this $2.5 million key money will be there to subsidize if there's any deficit in operations, which again, the projections show that there won't be much of a deficit, but it's there as additional security. Now, the fourth is, I would probably go to the strength of the projections. As I mentioned, the RevPAR, the bottom line RevPAR that allows this NHK JW Marriott investment to be successful is that $250 mark. So meaning if the hotel can actually attain that $250 RevPAR level, then we are in a good position. That our investment is going to get service, or we're going to get the targeted returns as well as the investment principal. Now, fifth, we also, as I mentioned, have a guarantee from the principals. So there are a total of 5 guarantors. There is Samuel, Daniel, and David Moon. Those are the two sons and the father of as the principals of the SMG group, and their 2 trusts. And so aggregately, their net worth is north of $140 million last time I checked, and there's an annual covenant to keep within a net worth and a liquidity level, and an annual test to attain that. So this guarantee, what that does is it guarantees the investment principal as well as the annual interest payments. So at the least, if everything that I aforementioned goes to doesn't work out, doesn't pan out, we still have the guarantee to rely upon. Now, sixth, we also have a profit participation, as I mentioned, and this is a function of us being a profit participant in the operating agreement, or the LLC agreement, as we call it. And within that agreement, we also have a priority of payment, meaning that the Moons, the sponsor, cannot get to any return, any money, any distribution, unless and until they pay us that profit participation amount. And so that also gets us the capital gains tax rate, which is a whole other discussion, but I'll just kind of leave that there for now. And so, we try to mitigate the aforesaid, risk factor by these different, layers of security. And I think that's what really sets NHK apart. That's what really sets, for example, for our limited partners, if there's a prospect of you being an equity investor in a commercial real estate, as I mentioned, we not only provide a passive investment opportunity, but we've gone through the trouble and the work to structure and put in these layers of security so that it's a better investment form for our investors. It was a long-winded answer, but I think the question itself was a bit probably loaded. So
Yeah, I'd say it was. While we're on the topic, a question came in. I figured we could really quickly address it.
Sure.
Are there any potential capital calls, or is that prohibited?
So no, capital calls are not prohibited, and that's for the protection of our limited partners, or actually the partnership itself. And by nature, you have the ultimate decision whether or not to participate in that capital call. But capital calls would come in, if there's a need to, say, exercise a collateral or such. However, again, I have to go back to the fact that at the bottom of all this, there's the payment guarantees from 140 million plus of net worth. And so at the end of it, if this doesn't work out, I don't think there's going to be a scenario where we're going to try to bring in more money through capital call or whatever in order to fix the problem. I think we would rely on the guarantees just to get paid back our investment and go home, if that makes sense.
Mm-hmm. Yeah, sure does. Okay, the next question, how does my quarterly distribution work?
Yes. Why don't you take that, Matthew? As you mentioned, you have an accounting background, and to me, this is more of an accounting maybe explanation than anything. So do you want to give us a
Yeah.
quick view of
Okay.
that?
Yeah. So as you mentioned earlier, that for equity loan, it has that 13% guaranteed payment, of which, you explained the split of how the annual fees pulled out, of which 10 to 11%, that'll be distributed on a quarterly basis. So, governed by that loan agreement, that's, how we would receive and how the distributions would work. Now, a form of kind of payments and cash flows would be, during the construction of this project, there obviously be no cash flows. So what we established was an interest reserve. This was set aside by the San Moon Group. It's 24 months, and it's pre-funded interest payments for our 13%. So the next 24 months, we will be receiving our distribution payments from that account. And then, as he mentioned too, you have that key money that comes in from Marriott. So after 24 months, the project's complete, and now the operations, have to be sufficient to then pay our distributions. Well, with the operations and the cash flow producing, Marriott actually provides $2.5 million upon operating the hotel. So that infusion of 2.5 will then, help assist any shortfalls while it ramp up. And that 2.5 plus cash flows will then go to, pay that quarterly distribution. And these will be distributed on a quarterly basis. If you invest starting tomorrow, you will actually start to accumulate interest. I'm not sure there'll be a distribution for this Q4 because it's a minimal window, but distributions will commence starting Q1. And as Neil mentioned, if there are any shortfalls of operations and the ramp up does take longer, and the Marriott key money, the contingency allowed is all used up and dry, and at the end of that operating quarter, there is a shortfall, then this is where the San Moon Group has to step up to the plate and obviously guarantee that interest and pay it out of pocket. Then again, if they don't, then Neil mentioned we can then pursue them under our guarantee. So that's kind of how the interest payments will be made. 24 months guaranteed from that escrow that's already established, and then the operation of the hotel plus the key money.
Cool. I know this is maybe have addressed it, but the quarterly interest payments, that's subject to obviously tax. And what does that look like for, say, a foreigner versus a U.S. person?
Yeah. So, and when any person invests into a partnership, they're issued what's called a tax form called a K-1. That K-1 will show any income received. And if you are a U.S. tax-paying citizen, then essentially your quarterly distribution, let's say it's $1,000, it's all given to you on the check, all up front. Then you, as an individual, as a U.S. tax-paying citizen, have to then file your own taxes and pay accordingly. Whereas if you're investing as a non-U.S. citizen and you do not have a Social Security number, on the K-1, the general partner of NHK will actually withhold approximately 37% to pay this. After discussing further with our CFO, say you are a non-U.S. taxpayer and you're having withholdings, and then you become a U.S. taxpayer during this investment, there is a chance that you can go back and recoup some of these withholdings. Now, I would advise you to discuss that with your tax consultant, but that's essentially the two differences. If you're a taxpayer in the U.S., you have a Social Security number, there's no withholdings. If you are a non-taxpayer and you're not a non-U.S. resident, then there will be a withholding. So that's
right. So the key word there, withholding, it's a withholding. It's not an effective 37% tax rate. Rather, it's a withholding with the ability to, if you do become a U.S. person, then to go back and sort it out and maybe it be more of your tax bracket than that 37% withholding rate.
Yeah, that's correct. That's correct.
Right.
So there is a chance. Yep.
Okay. Any other questions you thought would be worthwhile?
Yeah, I got one more question before we open up to the live questions that we've been receiving. Can you explain the GP's role and interest in the partnership? What is the fee structure like?
Sure. So again, this NHK investment is on a limited partnership structure. Now the GP, I think, the whole presentation was about what the GP does upfront, meaning, we structure the project, we put in these mitigations, that are an attempt to mitigate and risk adjust the investment. And moreover, during the course of the investment, the general partner is the entity responsible for the day-to-day operations. And truly, that's why, our limited partners can have a passive platform, and while having an exposure to a complex commercial real estate in the US. Now, should things go not as planned, then the general partner as fiduciary to its limited partners would go out and pursue remedies. And this could be going after that guarantee, as we mentioned a few times by now. It's going after the borrower if the borrower is not in compliance with the loan provisions. That's all on the general partner. So again, the general partner is the key component in a limited partnership in order to avail a passive investment platform to its limited partners.
Yep. And just to reiterate some of that stuff, I'm working on the compliance team for both the CMB and obviously the NHK side. One thing we do as the general partner, we, as my role, I follow the spending, I follow the construction progress. We have draw requests that have to be reviewed on our behalf before a payment's received. So, this is, definitely risk mitigated kind of situations where we put these in place to help us monitor and oversee it as a GP. So, but that would be the last question that we would have. We do have quite a few live questions that came through.
Okay, let's see what we have.
Are you ready? Okay. So the first one: what if by the end of 6-year time frame the hotel cannot be sold or at a bargain?
Well, so first off, I guess I appreciate the question, but I think maybe we have to go in a little bit deeper in understanding what a sold at bargain really means. Because as I mentioned, if the hotel can achieve that $250 thereabouts of RevPAR, then there is enough valuation, and that is shown by different appraisals, as is and as stabilized appraisals, for to take us out and also receive our projected return. Now, having said that, again, if anything doesn't work out, the ultimate guarantee is through the payment guarantee pledged by the 5 guarantors, as I mentioned, the 3 principals individually, and the 2 trusts. And this guarantee is a joint and several, meaning we can go after all of them. We can go after a subset of them. We can go after one of them. And long story short, the guarantee will cover as a payment guarantee for the investment principal, along with the annual interest payments. Yeah.
Okay, that was a good answer, I think. Next one: your numbers show a capital growth of 10 million to about 16 million. How does this relate to a 2x multiple?
Oh, yeah, that's a simple one. So when we talk about IRRs and equity multiples, we're looking at the entire return during the entire course of the investment. So I think what this question leaves out is they're looking at just the profit participation, the bonus at the end, which is that that 0.6. But there's a current pay structure as well, that is, another 10% or 13% actually of the equity loan principal paid annually through the course of that 5-6 year investment, target period. So that adds up to, just simple math, 50-60%. So now you have, in total, you get to that 2x equity multiple return.
Yeah, great. Yeah, like you said, it's not only just a growth opportunity, but it's also a stabilized annual earning opportunity too. So, next question: what happens if the investor refuses to contribute to the capital call? Will they be diluted? Will this only happen if the guarantors cannot fulfill their obligation on the guarantee?
So I think this question actually answers its own question in a sense that, yeah. So it I truly don't foresee a scenario where a capital call would actually be beneficial or necessary, because a capital call means that we're bringing in more capital than the initial investment of that $10 million. And I guess just scenario wise, what you can think of that might require a capital call is if there's a reason to fight, battle out, and incur, lots and lots of legal fees, or maybe incur, additional funding to, buy out partners or buy out, some other, structure, portion of the capital structure. But again, I don't think there's a scenario where this NHK investment will do that. Rather, I think we would rely on the ultimate, guarantee to pay us out. And so that guarantee is actually a pretty important piece of that way. And if there's a factor of a legal fees that are incurred by the partnership, then first comes again, we have a current income. So I think that would get that exhausted first before we ever go to a capital call scenario. So again, I don't really foresee, but never say never, obviously, but I don't think there's a very large window of scenarios where there's going to be a need for a capital call. And so, as I mentioned, the question answers its own question, because it will only come after any prospect of the payment guarantee is exhausted, which again, right now, and there's covenant provisions within the guarantee that stipulates that the guarantor has to maintain and sustain a level of net worth and liquidity throughout this investment period.
Okay, I think that's quite a good answer.
Thank
We
you.
got 2 questions left. What are the priority rankings of the types of loans on this project?
Good question. So again, this is a highly volatile, commercial real estate. If you were to think of it, so there's $80 million in senior loan, which is at the top priority. And there's $27 million of the mezzanine loan. And then there is the $10 million of the NHK equity loan that we're that is the subject of our conversation today. There is what we call a PACE function that's about a $4 million piece, and that is a pretty new I guess program that the U.S. is seeing. And what PACE does is, in order to facilitate and promote, some the I guess more environment friendly buildings, especially with energy efficiency, for example. There's a law that allows for a PACE financing that is tax tacked on to the tax payments. So it's a special, it's as if it's a special assessment on the annual tax payments. And that $4 million now acts as an additional funding source for, things that will bring energy efficiency to the project. For example, the HVAC system, and if there are rooftop solars, that kind of stuff. So we have about $4 million of that is truly at the very top, but it's part of the special assessment. It's a as if it's a tax payment, so it doesn't really affect, say, the overall valuation of the hotel, if that makes sense.
Okay. And the last question's quite simple. When is the first quarterly distribution supposed to occur?
And I think, Matthew, you covered that. So technically it's at the end of every quarter, but we're in the middle of December already. So this quarter is, a pretty short one. So likely my expectation is the first quarterly distribution is going to happen after the first quarter of 2021.
Okay. Yep. That's what I think I was talking about earlier, how it would be, not this quarter, since it's a small window and it just wouldn't be feasible, but yeah, starting in Q1 of 2021. That's it for all the live questions, unless anyone else has anything left. Otherwise, they are all answered. And leave this.
Sure. Do we maybe want to give it a minute before we say goodbye to our listeners?
Yeah, let's give it a minute. See if they have any last questions.
Actually, I see a question in the chat box.
About the early exit?
Yeah.
Yeah, that was answered. It was
yeah. Okay, great. Yep. No, we
it was
did
about
answer that.
the redemption right of your
Got
capital.
Got it.
Other than that, I don't know if there are any other questions. So you'll be attending the ceremony this afternoon at the site.
Yeah, so the construction work has already begun. There have been some preliminary construction works, like mobilization of the labor, of materials that have been ongoing already. So, but today at 3 p.m. here Dallas time, Noreen and I are invited to the actual groundbreaking ceremony. We won't break any grounds literally, because as I mentioned, this is being built on top of a 10-story existing parking structure. But I think it'll be ceremonial. It'll be nice to mingle with the sponsors, the bank. The bank is a very, very strong proponent of this team of SMG. Bancorp South has financed their Renaissance Hotel, and that's how the connection or the relationship has been built. And they can't say enough good things about this developer. And so we're excited truly of being part of this this project.
Great. Hopefully you guys get some good pictures, maybe some videos we can upload to our
That's a good point.
Facebook, and everyone can then get a glimpse of it. So
Sure.
But it looks like no other questions have came in, so I think we can wrap this up.
Great. Well, thank you again for allowing us your time, and in understanding this JW Marriott investment opportunity with NHK. Our website is nhkcapitalpartners.com, and if you send us emails to info@nhkcapitalpartners.com, or directly to myself or Matthew. Mine is Neil Lee at NHK Capital Partners. Matthew's is M Temple, simple naming convention here at NHK. Then we'll be able to address your questions. If you would prefer to talk to a native speaker of your language, we can also facilitate that, as I mentioned. So again, thank you for joining us, and hope to see you on the other side.
Awesome. I appreciate the presentation, Neil.
Thank you.
Thank you. See you guys.